Indian stock markets are in correction. Is this the right time to invest? Over the past 4 months, the Sensex has crashed by over 10,000 points. Headlines are buzzing about how fixed deposits are outperforming stocks, and the NSE Large Cap Index has plunged by over 13%. Naturally, everyone is wondering, are we nearing the bottom? Is it time to start investing again? Before we dive in, here's a quick request. If you find value in this video, please share it with others who might benefit and join my Telegram group. It's where we discuss markets, share actionable insights, and stay ahead together. The link is in the description below. Now let's approach this calmly and rationally. Today, we'll take a close look at where the market stands through three key lenses: valuations, liquidity flows, and short term triggers. Let's start with valuations. Indian markets have always been a bit of a premium market in the emerging economies club. This isn't necessarily a bad thing. Premium valuations often reflect strong fundamentals, higher growth potential, and better corporate governance. But there is always a tipping point where the premium becomes too expensive and a correction is unavoidable. Right now, the price to earnings or PE ratio for Nifty 500 stocks is at 29.6 on a standalone basis. Historically, during sharp corrections like the 2020 COVID crash, this figure dropped to 20.8. What this tells us is that there is still room for valuations to come down further. But here's the key difference. Unlike the sudden shock driven crash of 2020, this correction is more gradual and prolonged, which means that it might take longer to find a bottom. When we compare Indian markets to other Asian peers, India is currently trading at a 62% premium to Asia ex Japan on a forward price to earnings basis, well above the long term average of 38%. Now, it is no surprise that India is among three least favored Asian markets at the moment in terms of investor sentiment. Here's a nugget. Corrections like these are a natural part of market cycles. They restore balance and create opportunities for long term investors to buy quality businesses at fair valuations. As Warren Buffett says, be greedy when others are fearful. But the question remains, are we there yet? The data suggests that we might have to wait a little longer. Now, let's talk about liquidity flows. Foreign institutional investors or FIIs are often referred to as patient capital. They don't invest on whims, they look for long term growth stories and favorable risk to reward ratios. For years, India has been a darling of FIIs due to its growth potential, but in recent months, this trend has reversed dramatically. So far, this year, FIIs have net sold 66,000 crore worth of Indian equities, and we are only in January. Even FPIs, who were major buyers for much of the past decade, have turned into net sellers. So, what is driving this exodus? One major factor is the relative attractiveness of the US market. With rising yields and a stronger dollar, capital is flowing out of emerging markets like India and into the US. This outflow has created a temporary vacuum in the Indian markets. Without FII inflows, the market's ability to sustain higher valuations is severely tested. That said, liquidity trends are cyclical. FIIs might be selling now, but they often return when the markets correct enough to offer compelling valuations. Next, let's explore short-term triggers. Even in a bearish market, certain events can create opportunities. Take Donald Trump's policies on deglobalization and trade barriers, for example. These are generally bad for India's IT services exports, but they've also opened up new opportunities in data localization, global capability centers or GCCs, and offshoring. Selective plays in data centers, system integration, and communication services could see significant upside even in this environment. The union budget is another crucial trigger. With GDP growth slowing for 3 consecutive quarters, there is a strong case for fiscal stimulus package. Historically, governments have used budgets to boost consumption during slowdowns, and this time it should be no different. I am expecting measures targeted at lower end urban markets, which could benefit sectors like apparel, durables, and entry level automobiles. Finally, let's talk about RBI's monetary policy decisions. Interest rates play a crucial role in the economy because they determine the cost of capital. When rates are high, borrowing becomes expensive and which can slow down growth. Conversely, rate cuts can reduce the cost of borrowing and spur investment and consumption. In my view, the RBI has kept liquidity too tight for too long, and the result is evident in the slowing credit growth. The upcoming February policy meeting will be critical. If the RBI announces an interest rate cut or a CRR reduction, it could inject much needed liquidity into the system and reignite growth. Globally, if the US Fed cuts rates as Donald Trump has been advocating, liquidity conditions could improve worldwide, further supporting Indian markets. So, where does that leave us? The correction we are seeing is being driven by a combination of high valuation, FII outflows, and macro headwinds. While there is still room for further downside, these same factors are also setting the stage for opportunities if you know where to look. If you found this video helpful, don't forget to share it with others and join my Telegram group where we have in-depth discussions about markets, stocks, and everything in between. Finally, I'd love to hear your thoughts. Are there any specific markets or stock related topics that you would want me to cover? Drop your suggestions in the comments and I'll be sure to consider them for the future videos. Thank you for watching and I'll see you in the next one.